The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
And the first chart that I posted into Tiger TV today is the one that's getting the most press today, and that is the dollar-yen. The dollar is really screaming against the yen. As you can see, if you'll take a minute, then go into Tiger TV and look at this chart, because it's a really beautiful technical picture, because it shows the AB equals CD move that completed last night right before the announcement. It was an exact equal move to the last sell-off that we had in late February, and now we had the exact same thing occur this time, only this time it was a perfect ABCD that took several weeks to complete. And then, as you can see, it's moved $3,000, which is a huge amount in foreign exchange, in a matter of a few hours. And that was coming right off of the 61% retracement, and had little higher bottoms there right before the announcement, and then it just literally, went, pretty much ballistic. The chart is in Tiger TV. I'm sure I put it in, but I'll post it again at the break. But I wanted to mention I better put it in now. I wanted to mention about the Gartley book itself. Okay. The Gartley book itself was actually not a book. It was a 3-ring binder. It was in with punch holes and stuff like that. It was 700 pages, and he started doing it in 1935, and he finished it in 1937. It was not published as a book until 1983, and I found the book, or what it was called a book, the pamphlets, in 1970. I was trading out of the Conti Commodity office in West Los Angeles, right by UCLA on Wilshire Boulevard, and about a mile away on Little Santa Monica Boulevard was the Investment Center bookstore that was run by Don Mack. Don Mack had the most pristine collection of books in the whole world, and his mother happened to be a diabetic, and I worked for Eli Lilly, and I had access to free insulin for his mother, and he gave me access to the whole library. And the first thing I asked him, I said, "Where's the best book in here?" And he said, "Sit down and look at this one." And it was the Gartley book. In 1983, I convinced Billy Jones from Lambert Gam Publishing to publish the book, and they finally did, and it's been a very popular book. And the pattern is certainly helped a lot of people. We got a caller from Tampa, Florida. Tom, are you there?
Hey, Larry, how are you?
I'm good, sir. How are you?
Good. Can we take a look at that euro? It's been up and down and all around this morning. That baby went down hard this morning, and out of nowhere she shot up to about 128.68 in that area. You think that rally on this baby might have started a little bit, or do you think this baby's just out of steam?
I think it's got a chance, and the reason why I think it has a chance, I'll put the chart in here that I was looking at last night, because I was waiting for the the market to come down to that level. Let me see if I think it's on the 60-minute. I hope it is anyway. Yes, here it is. I'll put it in here, and I'll show you the fact that we'd had these higher bottoms all along, Tom. And what was interesting this morning is that we made a lower low by just 1 pip than we did on the 27th of March, and then usually if this market's going to go down, it's going to go down really, really hard. And of course, we rallied, well over 130 pips. Part of that was, just sympathetic buying from the dollar versus the yen too. But we're very, very oversold in the euro. We made a lower low today, so that means we're down like 13 weeks. So we're very oversold. So we could get a little bit of a bounce. But longer term, this thing looks like it's got 100.
Longer term, yeah. But as a short term, I mean, it's just been, I mean, it went down there pretty good. But, yeah, it looks like we could still get something here short term then.
Yes, well, you've moved. We had a bigger move in 2 hours than we've had, since the end of last month. So this is that's the first sign. And all we did is we took out the lows of the 27th, and then on the rally up, we took out the highs of April 2nd. And so what you would watch for is to see what the little pullback would be. You'd expect it got to 128.80. So if it can hold 128.30, which would be a 382 retracement, then it has another chance to to go higher. So that's that's what I see in the euro. But long term, it looks like chopped liver.
Oh yeah, and that's an understatement. Yeah. Okay. All right, Larry. Appreciate it.
Thanks a lot for calling in, Tom. You live in a great city. I love that place.
Oh yeah, absolutely.
Okay. All right. We got 2 callers in a row. Holy cow! This must be a trend day. We got a call from Lou in Nashua. I think that's New Hampshire. Lou, are you there?
Yes, I'm there, Larry. I was wondering if you could look at Con's taking a beating. I'm just wondering if there's more downside to.
Oh yes, yeah. We were gonna. I was gonna do that on the second part of the show, but I can do it right now because it's one of the things that that we're waiting on for. If you'll take a look into Tiger TV, you'll see that we're heading down to the 619 level. We left this huge gap, and what we're waiting for is to see the same type of pattern that unfolded last Memorial Day, and that's where we had all these ABCD patterns happening, and we're having the same ABCD patterns happening now. Last year at the same time, they came out with a very, very bearish report, and then, of course, there was no water coming into the plants, and we had a drought, and, corn rallied $15,000, a bushel. And so what we're doing is we're waiting for a low-risk entry, and that will probably come in late April would be my guess, Lou. That's what we're waiting for.
Okay, so you're waiting for higher prices.
Well, no, waiting for lower prices to buy. I think we're going to be, we'll probably have some kind of a bounce in here. We might even try to go up and fill the gap up at the 675 level. But frankly, this is not the time to buy corn. We left this huge gap on the crop report last week, which was pretty much a game changer. And we had Rich Anderson on yesterday from Anderson Capital Management, and he said it was, definitely a big surprise. But they have another report coming out on the 10th of April that will probably mitigate it a little bit because, they change the numbers all the time on these reports. So now's not the time. If you'll listen in on all of my shows, because I'm going to be following corn daily, either Monday, Wednesday, or Thursday, I'm going to be, promoting corn one of these days, probably in the next 3 or 4 weeks, to take a look at it. But right now, it's in a really big downdraft, and you can't touch it here.
Mm-hmm. Okay, so you're looking to go long if it goes lower.
Yes, about another 30 cents. It should have some support, and we're just waiting to see. The ideal thing would be to chop around here for 3 or 4 weeks, so that the crop is completely planted and everything, and then they're getting the beans planted around the 1st of May, and then then the weather becomes a factor, and that's we've never had a year in my 54 years of trading, Lou, where we haven't had at least 1 or 2 crop scares. I mean, it's every year. I mean, it's how they promote the corn, I think.
Gotcha.
Okay.
I appreciate that, Larry.
You bet. I hope that helps. And then also we'll be looking at that ETF CORN because it actually trades well, with the corn. And if you're not interested in futures, you can able to do that pretty easily.
Okay. Thank you.
Okay. All right. The next thing we wanted to talk about on the commodity show is the commodity index itself, which is the DBC. And when I was doing this, I moved my machine around a little bit, and I have to get it back up here. And we have it right now. And I'm going to put it in, and you'll see that we've been pretty bearish on these commodities for quite some time. Going back into late January, and we're breaking down. pretty quickly now on some of these things, and we'll cover gold and silver, of course, after we have the first break. But the real key here is, folks, this market, the stock market itself, is going to have a very difficult time to go up here because, all these commodities are getting hit. These are the things that make the products that these companies sell. And if they're going down in price, that means they're not buying these products. That means they're not making these products. I don't care what the charts are telling you. This stuff is just not moving off the shelves. That's the bottom line. This is what happened in 2007. It was giving you some indications of that. We had that big run-up in silver. We had that another run-up in the grains and stuff, and then it all started to unwind, and that's pretty much what's happening. Now, part of the problem that we're having in the commodities now is that CalPERS, which is the big retirement fund in California, has pulled $1 billion out of their commodity fund. In other words, they reduced it from $4 billion to $3 billion, and the $1 billion in commodity is a lot. So that takes out a lot of the stuff. And a lot of it is unwinding of some long positions would be my guess, but most of it has to be related to supply-demand, that people are just not buying it on the way down. I was very, very bullish gold, when it was back around 1560 a few weeks ago, and we had the nice rally up to 16, I think we had 1620 or something like that. No, we hit 1612, and then it just couldn't even make an ABCD correction. And silver was going down all that time. We were posting charts showing, what's wrong with silver. It's an industrial metal. Something's wrong. Silver, has a price target, in my opinion, in the low teens. I don't think it's not very, far away as near as I can see. So that's what we're looking at in some of these commodities that we're watching. Industrial commodities like copper, we've already, talked about copper several times on the show. And, it's still, just breaking badly all the time. It's not making new lows today, but this is one of the first time in a long time that it hasn't made, new lows in copper. And so that's another negative sign that, something is really amiss here. If we can get the S&P to close below the 1540 either today or tomorrow, then, I would think that this would be the first time that they've, rattled the cage a little bit for the longs, and that they have a little bit of, fear in their hearts. The VIX is telling us, like Basil was mentioning on his show, that the VIX has had some kind of bottom form down there around that $12 level. We're trading at above 14 now. So, it's at a time where it's due to turn because everybody is on the bullish side. I mean, there's very few people that think we can have a bear market. There's some people think we might have a 5% correction, but there could be a lot worse than that. Anyway, we're going to take a little break here. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and we were talking about silver and gold, and I posted the 60-minute chart of silver along with the overlay of the gold market on top of it, and you can see, the big collapse that we've had, and we've broken below the $1,540 per ounce level in gold earlier today. So far, we've held above it, and we're very oversold in both of these, so we could get snapback rallies without any trouble, much like we had in the euro. But longer term, this is a really a very, very poor performance of gold, given the fact that we had this problem in Cyprus, which we've mentioned before. The market just did not respond to the news. Now, the chart that I posted into Tiger TV just recently comes from our friend Graham Corbishley in New Zealand, and he has the gold bug index graphed out showing the patterns that we're looking at. He's looking at a butterfly pattern, which is nothing more than a failed Gartley pattern. In other words, when the point B is exceeded, that tells you that you're, moving up into a sell pattern, which is known as a butterfly. Also, within this chart, it shows a 5-point reversal. In other words, where you have waves 1, 2, 3, 4, and 5, each going lower and higher. It's also known as an expanding triangle, and it's one of the more accurate of all the patterns that we look at, because within that expanding triangle, you have a 3-drive pattern, that is occurring, at that time. By the way, someone asked the question. The Gartley book is available. It runs about $100. I think it's a little over $100 now. It's 700 pages. Frankly, the only pages that I've spent any time with are pages 200 to 250. Those were all the patterns that he talked about. And on page 222 is where he described the Gartley pattern. And he described it very, it was very difficult to understand what he was trying to say. It took 2 pages for him to do it. And the diagrams that he had were not correct of what he was describing in there. And that's why I called the pattern the Gartley 222 when I first started to write about it in 1974. I wrote for, I think it was Futures Magazine at the time. And then I went to work for Drexel, and I didn't do any more writing for 6 years. But the pattern is very, very good because it forces you to trade with the trend. You're either buying a higher bottom or selling a lower top, and it helps you put your risk control, and it gives you a minimum of 3-to-1 price-reward ratio, and that's what you're really looking for. But the price that we're looking for now in the gold market, if we break below 1522 in gold, and we're only $20-some away from that, we're looking at a price of around $13.75 per ounce. That would complete a very large AB equals CD on the weekly basis. Silver, if it breaks below the $26 per ounce, that would make it a price objective around the $18 per ounce level. So that's what you're looking at in the precious metals. Copper still, even though copper is up a little bit today, it still looks like it wants to go to somewhere around $3 a pound. We've been mentioning this in copper for weeks, is the fact that it's been so bearish with the stock market going up. I mean, you had to really try to find some way to buy copper if you wanted to be bullish, because technically it was really a dog. I mean, it had lower tops all the time that the market was going up. It was screaming that there was something not right there. And now, the rest of the world is seeing that, it is starting to go down. So, whether it turns around from this level or not, I don't know. Someone posed the question is, how can the stock market, be this high, when when all these other things are going lower? Folks, go back to 2007, October. The market was making a new high. It just made a new high from the previous July by just a little bit. And then from, there it dropped, better than 60%. So just because they make these new highs, it really doesn't mean a lot. But the problem that we're having is that we have so many of these patterns that are bearish in everything. We discussed that on yesterday's show. We went around the world. No, that was on Monday's show. We went around the world and showed you, London and Germany and Asia and all of them. They're all completing bearish patterns, and that's a very unusual situation. In all my years of doing this, I don't think I've seen it this way on a global basis. However, we didn't really watch the global markets until the 80s. I mean, there was not much, information coming in during the 60s and 70s. I don't even think the DAX existed at that time. I'm not sure of that, but I know the FTSE did, but the DAX, I'm not sure. We got to take a little break here to pay some bills for our fearless leader, Tom O'Brien. 877-927-6648.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit, and on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, folks, I posted an article about global warming that came from our friend Marshall from the Tiger's Den, and it's from the Washington Post, and it tells the real drastic nature of global warming. The problem was the article was written in 1922, so this has been around for a long time. That's 90 years. So, just because you read things, you got to do your work yourself. Defy human nature and do the work yourself. That's what you have to do. That's in trading, too. You have to take the responsibility, for what you're looking for. Now, we've been talking about the bond markets for quite some time. We're waiting for a little bit more of a rally in bonds. What I'm going to do is post into the Tiger TV area so that you folks can see that if we get up to this 148 level, which is we're only 2 points away, we've moved in the past 3 weeks. We've moved a total of 6 points. So we're only 2 points away, from the level that we're looking at, and we could get even higher. We could get up to that 150 level. So we'll need a pattern to verify, this price level that we're looking for, because this, I think, is going to be the ultimate short. I believe we're going to see higher interest rates starting sometime, now, and then we'll see. By the way, the 10-year note or 10-year bond in Japan was yielding 0.44. Now, I don't know about you, but there's not many people that I would loan money for at 0.44% for 10 years. That doesn't sound like a very good deal. And it goes back to that old adage that was in Bernard Baruch's famous book, My Own Story, his autobiography. He says, if it looks like it's too good to be true, you can rest assured it most probably is. So there'll be some real ramifications here. Realize that the experiment that Bernanke has done with his QE programs has now gone to Japan and also has gone to Europe. They're all coming together. All the central banks are doing the same thing. They might be doing the right thing, and maybe this is going to work out. Maybe history is going to be wrong this time, but it appears that they're flooding these things, with a lot of money. But if it were really that way, gold would be trading at 2,200, not at 1548. That's my opinion. And the dollar would be, in the sewer because they would dilute the dollar in order to pay back the bonds with a cheaper paper. So just looking at the charts, it's a very ominous, ominous situation in my opinion. And believe me, the Fed did not see anything wrong with the economy in 2007. If you go back and look at Bernanke's comments from the Fed minutes around in October of 2007, it looked really rosy, and they could see no sign that the housing market was going to turn down. And yet we had one of the worst collapses, that we've ever had. That hurt a great deal of people, many of whom haven't recovered and probably won't for years to come. So we'll have to wait and see what history says about this bond program that they have. But it doesn't look like it's. It just doesn't look like it doesn't make any sense to me. It just really doesn't make any sense. That's that's the bottom line of what we're watching. Now we have a one commodity right now that is making a very serious correction here, and I wanted to bring it to your attention because we all use this product. It's crude oil, and we are right at the 61% retracement now. Exactly at 92.68 per barrel. We completed the big ABCD move up at the 97 level. I'll put that ABCD leg into the chart, and then you can take a look at it, and you'll see that it fit the parameters for the swings that we look for. But we are right at the significant bottom now for crude oil, and so our fund, a hedge fund that I work with, we went long the crude today. And not risking very much here, just less than $1 a barrel. So this is going to be an interesting one because it's had a nice correction of about $5 a barrel, and that's right at the 61% retracement, and that's coming off that Gartley sell that was up around the 97 level. So whether this works or not, we don't know, but we try to quantify our risk and see if things will work out in our favor, because that's all you really can do. Remember, folks, when you're trading, you never know whether you're going to win or lose. You never know that, and you never know how much money you're going to make on a trade. Those two things are they cannot be challenged. The only thing that you can do when you're trading is to protect the amount of capital that you're trading, and that's what you focus on. Focus on how much you're risking when you're putting on a trade. If your strategy is such that it gives you a positive probability, which pattern recognition will do, and it's certainly far from being, perfect. If you can just get to be 6 out of 10, you're going to do extremely well because you're going to have a few break-evens and a few losses and 6 profits, and 2 or 3 of those are going to be pretty good, and the others are going to be just marginal. But that's the bottom line. That's what it's all about. It's about probabilities and risk control. That's what trading is about. Everybody thinks about when they put a trade on how much money they're going to make, and they must reverse their thinking. You have to put the trade on thinking, how much money can I lose on this trade? because all you do is you just move on to the next trade. That's basically that's it. I have to give a little story here. Really, it hit me home really good today. I was watching CNBC just to get some ideas to talk about, and the guest that they had on was actually Bloomberg. Sorry, it was on Bloomberg, and they had Reggie Jackson on, the great baseball player from the New York Yankees and Oakland A's, and he's known as Mr. October. And my best friend growing up in California when we were raising our kids was Dennis Inouye, and Dennis had two little boys that were in a Little League, and their favorite player, of course, was Reggie Jackson. Well, I had quite a few of the Los Angeles Dodgers were my clients when I was at Drexel, but they played in different leagues. The Dodgers were in the National League, and the Angels, or the Oakland A's were in the American League, and they wanted to get an autographed ball from Reggie Jackson. And so my good friend from the Dodgers, Tommy John, who I grew up with in Terre Haute, Indiana, arranged for me to go down to Anaheim to the Angels Stadium. It was a brand new Angels Stadium at the time. We took the boys and we went to the game, and he had set up so that after the game we could meet Reggie Jackson and get an autographed ball for each of the boys. And what happened was it turned out to be something really, really spectacular, because after the game and the Oakland did win, Reggie Jackson took us out to dinner, and he gave the boys a hat, a baseball, and also a baseball bat, and it was really memorable. And I didn't know this until the time of the dinner that Tommy John and Reggie Jackson were very, very close friends, and they've remained close to this day. So, but anyway, it was watching him on TV today brought back so many memories. It was really something. It was really great. Tommy John played for 28 years in the majors. He had 296 victories, I believe, and just missed the Hall of Fame. He needed 300 victories, to get into the Hall of Fame. But what a illustrious career he had, and it sure was fun for our family, because he treated us very, very well all those years. We got to go to the World Series games, and it was terrific. Anyway, that wasn't my most memorable baseball story. I'll save that for another day. But anyway, that was what was fun today. But they're auctioning off some of the jerseys and stuff from Mr. Jackson, and what we're going to be doing is finding out how much they're going to sell for. Ruth's jersey went for $4 million, and I don't know what his is going to go for, but it's going to be probably something really, really spectacular. I would think somewhere in the $2 million area. He offered the jersey to Steve Cohen, but Steve Cohen did not want to pay the amount that Reggie wanted for the jersey, so that'll be interesting to watch. But they're paying so much for some of these trivial things. It almost reminds me of the era of the Great Gatsby, and that's really a different different time altogether. Now I want to do the long-term picture here for the crude oil here, because we have a situation that if we break much from where we are right now, we have a potential for the market to go a great deal lower. So if we go below $92 a barrel in oil, that's going to be a very negative scenario for the patterns that we look at. So these commodities are breaking down, folks. This is the commodity show. I mean, we can go. I've gone through these last week, and nothing's changed except that they continue to keep going down. And there's no bottom in sight for some of these things, as near as I can see, looking at it on a technical basis. And that's all I can say. So someone asked me a question just now about Apple, and I've said all along that we have a price objective of $3.94 per share. It's trading at $4.28 now, so it's within about 5% of that level. And there's an announcement today, I understand, that Apple is going to come out and revise their last 2 years of earnings using a different accounting method. That alone would scare the heck out of me, and that could be the thing that could push the Apple, below the $400 level. But if Apple doesn't get below $400 a share, in this environment, I'll be very, very surprised, because it sure has a lot of targets going right directly to that level. I heard Basil mention the 353 level, and believe me, anything below 390 and 353 could be made, very easily. And this was a stock that was trading, just a few months ago, back at the $703 per share level, and they had $100 billion in cash and stuff. But that's the way things move in these markets. You just got to trade what you see and not what you think. That's the bottom line. And if you do that, you'll be far better off than if you try to follow the fundamentals. I have never had any luck following fundamentals, and I don't think that's going to change. I'm going to put the long-term chart of Apple in the Tiger Den, because it does have. I've got to do the daily first. Hold on a second here, and you'll see that the price objective that we're looking for will come in around the 394 per share level. But anything below that, and that would also be a 3-drive pattern. That would be an ideal situation, for folks to look at a long position, in the Apple if it gets down to this level of 394. And we're only 5% away, and that's nothing in that market. It can move very, very quickly, as we've seen. But we've been down since September. It's incredibly oversold. All of the rallies have only been $50 per share, and so even though it's not a commodity, it will be a interesting one to watch, because it trades so beautifully, on a technical basis. It certainly does a really good job with that. Now, we also mentioned a few weeks ago, that we were buying cattle, and cattle had a very good run to the upside. We're having a little bit of a sell-off now for the last couple of days, but it's very, very minor. The position still has better than 2 points or $800 profit in it, so it's holding really well there. So if you happen to be in the cattle trade that we talked about several weeks ago as well, it was back on the 18th of March, you should put your stop at break even, and that way you are in a risk-free situation. There's a situation where you could take a profit here if you like, or you could put your profit or put your stop at the break-even level, and that would be the interesting, probably the best way to handle it, because you're risk-free, and that's the best possible thing that you can get. So that's it's pretty interesting to see this. I opened a can of worms in the Tiger Den, because they're talking about Tommy John and the fact that he had this surgery with Frank Jobe, and where they reconstructed his lateral tendon. And I remember that because Tom was living in, what was the name of that? Fountain Hills, which was just south of Dodger Stadium, and we went down to the house a couple times. Tommy John's wife, Sally, actually was going with my cousin. And once she saw Tommy John, she forgot about my cousin. And they have four kids. One of them happened to pass away, but they have a pretty good life. They live in North Carolina now, and he plays golf all the time. And getting old like everybody else, but a lot of memories. And he's still the nicest guy in the world. He's just as nice as can be. We got to take a little break here, and then we'll get back and finish up the show and talk a little bit more about the stock market.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, folks, I'm going to wrap it up. What I think are the 3 most important things to keep in mind looking at this market. The first one that I posted into Tiger TV is the New York Stock Exchange Index on a weekly basis going back to the high in 2007. And it shows that we've made a 786 retracement. It shows the butterfly pattern that is formed at that spot. It shows that the Dow Jones Industrial Average has far surpassed the New York Stock Exchange Index. But remember, the New York Stock Exchange Index is cap-weighted. The 30 stocks of the Dow Jones are price-weighted, just like they are in the Nikkei. The Nikkei Dow is also price-weighted. So a higher-priced stock can make the index move higher than a lower stock, even though the capitalization is totally different. The next chart that I think that is very, very important to look at, and that's the one that Basil has talked about for quite a while, and that is the VIX index, also on the weekly basis. And it shows the 3 year cycle that's there that's due to bottom now, and we're making a butterfly pattern in the VIX index, which we've already completed. We've already bounced off of that a little bit, but we'll really look at that very, very closely, because I think there's just so many people that are bullish, and it's really difficult to get a lot of people to buy this thing when you've had a run like we've had, and now everybody is bullish, and it really makes it extremely difficult to make the thing work the way you want to do. The next one I want to show you is the yield on the high grade or junk bonds. What's happening? People, because interest rates are dropping just like they are in Japan today, they're clamoring, they're buying junk, and that's what these are. These are junk bonds. I mean, they're high yield bonds, of course, but they are very risky. As you can see, in June of last year, they were trading at a lot lower level than they are now. So they move very, very dramatically, and that's why they are incredibly risky. And now what people are doing is they're buying these, and they're not interested in safety anymore. They're just clamoring for yield, and that makes it incredibly difficult to do the to get risk out of their mind. They're not thinking that way. They're thinking about how much they're going to make as opposed to how much they have to risk. That's the main thing of what we're looking at here. Now, what's happened in Japan? The fact that they have put in, I think, 12 trillion yen or whatever it was, of some ungodly amount to make the yen move $3,000 in one day. You have to go back a long time to see it move that much in one day, and it's a game changer, for interest rates in Japan. So they are going to try to inflate, and if it doesn't work, you're going to be looking at some pretty serious deflation, and that's what some of these commodity markets are telling us. I mean, they're telling us that there's deflation coming and not inflation. The dollar has held up incredibly well during this time, and the commodity markets are collapsing, and that's not good for the economy. It hasn't in the past, and maybe this will be the one time that it's different. But if you go back and look at history, and I'm going back, years and years and years, if the commodities go up, the stocks go up because the people are buying the commodities to make the products that people buy to get the earnings. That's basically the same thing, So we'll see if that's it. Everybody have a wonderful weekend. Live every day in an attitude of gratitude, and may God bless.